welcome to Money, Money, Money. I'm Sumera Abdi. Wild swings in the market now seem to be the new normal. A lot of anxious investors out there starting to liquidate their portfolios and moving to the relative safety of cash. But here's where experts say that things start to go wrong. When the markets get choppy, it pays to have a plan for your investments and to stick to it. Over the long term, day-to-day market swings are relatively insignificant. The key lesson: when the market swings, it's time to hold steady. Pankaj Matpal of Optima Money Managers joins in now with his top tips on embracing volatility and thereby protecting and boosting your portfolio. Hi Pankaj, thanks very much for joining in. It's important because a lot of retail investors actually get really scared when things get choppy, right? But this is the time actually for them to be buying. But is it the time to protect your capital, or is it the time to actually buy for the long term?
So both the things are equally important: protecting your assets as well as growth of your assets, and that is why asset allocation plays a big role in that. Always there are three major factors which determine that where you should invest, and it is time horizon, objective of investment, and risk appetite. So based on that only, if you take decision, it is always will work for you. Sometimes what happens when there is noise in the market, say market is performing well, equity market is performing well, most of people then they start investing and more than what they should. So, and then when it is other way around, like markets come down and then they start exiting out of market. So only thing is that you should first set your goal. Based on your goal, if it is long-term goal like retirement, children education, then definitely equity should be in higher percentage of your portfolio. If your horizon is short, then definitely you should have less allocation in equity. So based on these things only, you can make a portfolio. So nobody knows that if 1 year ago you would have asked me that whether equity will be doing better in 2016, definitely answer was yes. But what we are seeing is not as expected. So this volatility in equity market in short term is always may happen. So based on that, the only thing that asset allocation based on your goals, that is important.
Okay, so if that's the case, and I have a certain risk profile based on which I have a certain asset allocation as well, right? And also according to my goals. Now, if my asset allocation is complete for the moment, and this opportunity has presented itself that the market has fallen and therefore becomes a great buying opportunity, should I go in for incremental buying at this point?
Definitely, it is like a sale in the market. So what happens in retail market also, when there is a sale, if you need one shirt, you buy two or more than that. So definitely it is an opportunity. If you have cash with you, you should invest more. But again, I'll say you should definitely see your risk appetite and your time horizon. Because if at this moment you invest more and you need money after 6 months, so there is no guarantee that you will really create wealth. But yes, if the money is kept for long term and you are waiting, this is an opportunity. Definitely you should increase your allocation.
Okay, so what portion of my portfolio then you think should be available for strategic investing and what portion for tactical investing?
See, strategic allocation, because you believe that some percentage returns you should get from your portfolio, and based on that, with the 60-40, 50-50 allocation you make. But actually, that is a passive style. But if you want to manage a portfolio actively, then definitely you should take benefit of timing the market. Though it may not be possible exactly to time the market, but when the opportunity arises like this, what we are experiencing right now, then you should increase your allocation in particular asset. So if this is the time you are expecting better returns from equity, you should increase your allocation in equity. And when you feel that markets are up, you should exit out of that. So there are two things. One is definitely based on goal. You should not change that allocation. But yes, some money if you have, and you should have for these regions. So you should actively participate in the market, and when such opportunity arises, then you should encash that.
Okay, so don't stray from your goal too far, right? But use the opportunity, don't lose it.
Definitely.
For sure. All right, you spoke about a passive style of investing, right? Is there a case to be made, or is it actually a style that's worth pursuing, especially when volatility picks up so much? I mean, does overly managing or overly being active manager of your portfolio actually harm the portfolio at times?
Actively managing portfolio, if you have time, you have access to research, then it may help you. But most of the time what happens for retail investors, they do not have time to manage their portfolio, and sometimes based on the tips or based on your broker's advice, they buy stocks. It may go wrong. So what I believe is that you invest in mutual fund. If retail investors do not have much time, invest in mutual fund and let fund manager do the tactical asset allocation, because definitely that is their job. So tactical allocation will really help getting better returns than the passive investment style, but let it do, means expert should do it rather than the retail investor, they start doing themselves.
Okay, so either you buy into mutual funds and let the tactical portion be taken care of by the fund manager, or you then sit on the investments that you have and don't try to jiggle it too much.
Exactly, but again I'll say one thing, like two things I have always seen. One, people do SIP. They know that SIP gives you benefit of rupee cost averaging. So when you invest in SIP, volatility is good. Because otherwise if market is only going up and you're investing through SIP route, then there's no benefit of that. But the worst thing is that when the markets are choppy, people start exiting. They cancel their SIP. So one is this. So if that is also kind of like SIP in long term will give you average returns. So that is one, people should remain invested. Second thing, in mutual fund also, suppose you are not investing directly in equity market, but when there is an opportunity, in lump sum also you should add to your portfolio. Means if you're holding some money, you're thinking that when the time comes, or you were thinking to invest that money through STP or SIP mode in strategic, in staggered manner. So right now, if you see an opportunity, at least not the whole amount, but a bigger portion of that can be invested.
Okay, fair enough. So mostly it still has to do with my risk profile, right? If I'm like entirely risk averse, perhaps this may still not appeal to me. But how do I know if my risk profile has changed, and therefore how do I take advantage of this volatility?
So my risk appetite, sometime when I ask this question and people usually say, no, I have never invested in equity and I will not invest even. But it may not like that they don't have appetite, but they don't know equity, because they have heard in the market that people lose money in equity market. And fact is that many of them have lost. So they don't understand that way of investing was wrong. Equity markets were not bad, but their style of investing or their timing of investing may be incorrect. So that is why once you educate people about equity market, you tell them that how it works, how that risk minimizes in long term, then definitely they may invest. So risk appetite, maybe two things. One is that if you are talking about a retired person, he does not have a scope of earning after that. So for them, I understand that they should have limited exposure. But a young person also sometimes says that I don't want to invest because I have heard that people lose money. It means that he doesn't know, he's not properly educated about stock markets. So it is better that whether really a person does not have risk appetite due to certain reason, or it is because of their past poor experience. In this volatile market, there are some schemes which are managed differently. Like for example, there are some funds which have dynamic allocation. Equity and debt allocation is not fixed. Based on the market, when the equity markets are performing better, they allocate higher percentage in equity. And when this is the time for say debt, they have higher allocation in debt. So these schemes are better doing in this kind of market. As we were discussing, the retail investor, they cannot manage their portfolio on their own. But fund managers, they have better knowledge than the retail people. So I'll say that for them, it is good to manage this kind of funds. So some AMCs have introduced this kind of scheme which are based on the dynamic asset allocation. So retail investors should take advantage of these schemes.
All right, so that's fair enough. Actually, don't always blame the market. Equity is not entirely evil. So the key takeaway, if you're a long-term investor, is to resist the urge to make drastic changes to your investment plans in reaction to the market moves. But we're not done yet. Still ahead, is cash really an asset class in times of distress? Find out when we return. Stay with Money, Money, Money.